Hello, everyone. Welcome to yet another very informative session from Indoindians.com. And today, we are very honored and pleased to have with us our expert speaker, Chartered Accountant Ajay R. Vaswani. CA Ajay Vaswani is a distinguished accountant with expertise in NRI taxation and FEMA regulations. With qualifications in commerce, law, and company secretaryship, Ajay brings a multidisciplinary perspective to his advisory practice. Since 2012, he has focused exclusively on serving NRIs, building a trusted reputation for precision and compliance across 20 plus countries. As the founder of CA for NRI.com, Ajay offers specialized services ranging from tax planning and return filing to real estate transactions and fund remittances. His insightful approach and commitment to excellence make him a sought-after expert in the field of international taxation and regulatory advisory. So welcome to Indo-Indians event, Ajay. Thank you so much for joining us.
Thank you so much, Poonamji. Much delighted opportunity. Thank you for inviting me to this platform. Would be very happy and glad to interact with the fellow NRIs living in Indonesia and around. Thank you.
So I just wanted to let you know that this session is also being live streamed on YouTube and Facebook. So if anybody would like to go back and refer to it, we will send you the link. I'm now going to hand it over to Ajay, who's going to do a presentation. And if you have any questions, please put them in chat and then we will go through a Q&A session. This session would be around 40 to 50 minutes long. Thank you. So over to you, Ajay.
Thank you so much. Can you confirm my screen is visible?
Yes, it is.
Thank you so much. Good morning, good afternoon to everyone over here. And connecting on a topic which has been an ignored one rather, for the very reason that you stay outside India for a couple of years, you are not much familiar with the do's and don'ts around in India. But since you have a roots connected back to India, you have investments over here. Certainly, you have some incomes coming in. It is important to be updated what are the do's and don'ts around the taxation system in India as a non-resident Indian, because penalties are costly, because non-compliance would certainly lead to a monetary penalty being enforced. So as a precaution, what we should be doing is the agenda for the today. It's been 13 years now. I work only for non-resident Indian. And for that matter, I don't have even a single resident client. So over the years, 13 years of my practice, whatever Q&A have been received to me, I have tried to incorporate it the same in the today's presentation. And this is not more of a theoretical presentation which I am taking you today. This is more of a practical based. Whatever questions have been coming to me, I have tried to incorporate in the presentation and we would be taking through the same. And of course, you can feel free to put in your questions in the chat box. In the fag end of the session, we will take up the Q&A. And you have my mobile number also. In case your question is unaddressed or you want one-to-one discussion over your personalized question, you can feel free to reach out to me. Let us first understand who is a non-resident Indian. For an individual to be called as an NRI, there are two rules and regulations governing. One is, of course, the Income Tax Act, which has been recently updated. There is a new bill. The Income Tax Act 1961 has been replaced with the Income Tax Act 2025. And second is, of course, the FEMA, Foreign Exchange Management Act 1999, which is more of a regulatory law. So it tells you what transactions you can do, what bank accounts you can have, where money can come in, how money can go. And this is pure intention-based law. It is unlike in revenue law, which is income tax, where you see the number of days you have spent outside India. That is when you become NRI. In FEMA, we just see the intention. So tomorrow, if you are there in Indonesia on a work permit and you are not going back to India very soon, you are a non-resident Indian as per the FEMA on the day one itself. So that is where it is important for you to convert all your saving account to NRO and open your NRE bank account. So this is all is provided under the FEMA, and it is practically governing your financial transactions and the investments eventually you do back in India. But now for us to focus more on the taxation part, we need to understand who is an NRI as per the income tax. The thing is very simple. I will not complicate and not spend much time on that. It is, if you are staying more than 183 days outside India, you are a non-resident Indian. For you, NRI based out of Indonesia, you would have primarily two types of income. One would be the income coming in from the Indian sources, and second would be the income which is coming from the foreign sources, which is primarily like your income that you are earning while you are working in the foreign country. Why this is important to understand the Indian income and foreign income? Because foreign income for you as a non-resident Indian is exempt from taxation in India. It would be chargeable only in the country where you are earning the same. Whereas if you are a resident or a non-resident or RNR, this is a third category which I will highlight upon. Indian income is always subject to tax. So whatever be your residential status, any income that you have in India is always taxable here in India for you. So primarily if we see residential status is of two types, either you are a resident or a non-resident. Being a resident, there are two subcategories. So either you are a resident and ordinary resident, or second condition is you are resident but not ordinary resident. So in case you are an NRI, you are looking to come back to India for good. Before you become an ordinary resident, there is a migration phase, there is a transition phase, which is termed as RNOR. While you are in the RNOR phase, whatever is your continuing foreign income is exempt from taxation in India. How do you qualify to be RNR? You have to see two conditions. If any one is fulfilled, you are good to be call yourself as RNR. Now, what are the condition is? Condition number one, you should be non-resident in India in at least 9 out of 10 preceding previous years. And the second condition is your stay in India should be less than 729 days in last 7 years. If you fulfill any of the condition, you are qualified to be RNOR. So in case you have been an NRI for over 10 years, you come back to India for good, primarily based on the concept, you get 2 years of transition phase or 2 year of RNOR phase where your continuing foreign income is exempt. The third year when you become ROR, that is when your foreign income becomes taxable in India. For the purpose of classification, income tax has made 5 major heads to classify the sources of income. So number one is your salary. Second is business and profession. These two are not really much of relevance to you because you don't have a salary income in India, and very few actually have a business or a professional income accruing or being received in India. But the next three are very relevant for you because I'm sure you have some of the other heads of income coming under into these three for your personal account. So if you have a house on a rent, it is governed under house property. If you are selling mutual fund shares on any property, it is governed in capital gain. And any income which is not classified into the 4 major heads is put into income from other sources, which is primarily like interest coming in from your NRO account or deposit and any other income source which is not classifiable into 4 major heads. Let us first understand about the taxation of the capital gain. How does the capital gain work? So what you have to understand here is capital gain is chargeable to tax only when the asset is sold, or in another term, when the asset is realized. So unlike countries like US, which charges capital gain tax on an income which is not even realized. So on unrealized, unaccrued income, they ask you to pay taxes. But India, the concept is only when you sell off the asset, whatever is the difference, whatever is the profit, in another word, whatever is the capital gain, you have to pay tax on that. So either it is from movable asset or it is from immovable asset. Both are different for the purpose of the taxation. And second thing, what you need to understand is before asserting what rate of tax to be paid is period of holding. The concept of period of holding is the number of months or the years you have been holding the asset before selling it off is to be seen. So either the asset is short-term capital gain or long-term capital gain. This is very important to understand the rate of tax which would be applicable and you would be liable to pay taxes on that. So if we have to see the movable asset, primarily it is stocks or equity oriented mutual fund. What do you see is period of holding is 12 months. It means if you have been holding the asset and selling it after a period of 12 months, this is classified as long-term capital gain. Whatever is the profit between the purchase price and the sale price of your stock or mutual fund, you have to pay tax at a rate of 12.5%. First 1,25,000 would be exempt. Over and above that, you have to pay 12.5% tax. Whereas if the asset is sold within 12 months of its being holding, it is classified as short-term capital gain. On that, you have to pay tax at a rate of 20%. Now, second major category here is debt mutual fund. Irrespective of the period of holding, tax is to be paid as per the slab rate. So India charges tax on a progressive slab rate. We have a dedicated slide, which we would be seeing in a couple of slides coming up. And then there are few more asset classes. I'm not going into detail, but if you see, Budget 2024, that is in the month of July 2024, wherein the budget was presented by the Honorable Finance Minister, the entire structure of the capital gain has been more or less streamlined. So it is just two major categories now, short term, long term, with either 12.5 or 20%. And if not, it is as per the slab rates. So this is how the standardization has been done. Things have been way drastically systemized and classified to be very easy to understand and pay off the taxes and easy to do the compliance as well. Now coming to the another head of capital gain, which is sale of an immovable property. This has been a major concern for non-resident Indians for large, for the reason, of course, it is involving a lot of money, good capital is involved, and plus there are a lot of intricacies around the taxation of a capital gain arising from a sale of an immovable property in India. And here the major change also happened in the budget 2024. So budget 25, there was no change absolutely on the capital gain sale of asset or an immovable property or a movable. There has been no change for a very reason. Budget 24 streamlined most of the things. Let us understand what did the change happen in the budget 24 and how it has impacted you as a non-resident Indian. For an immovable property, again, we are seeing the concept of period holding. So it is 24 months. That is 2 years that you have to see. If you are selling the asset after holding it for 2 years, it is classified as long-term capital gain. If you are selling the asset less than 24 months of its being holded, it is classified as short-term capital gain. Now, what did actually you consider for the date of acquisition purpose? So what we see is either the date of the possession or the date when the last payment was made to the developer. That is when you get the good title over the property. So whichever is earlier is considered as the date of acquisition, and it is not the date on which registration is happening. So maybe if you're buying a property in Mumbai, you pay 10% amount, you get the registration done. So that date is not actually the date of acquisition for the purpose of calculation of capital gain. It is the date of possession or the date of last payment, whichever is earlier is considered for the purpose of calculation of the capital gain. What was the rate earlier? So if you have sold a property until 22nd July 2024, this is the cutoff date. So whatever was a capital gain with the benefit of indexation, you had to pay 20% tax. That has been discontinued for any property which you're selling on or after 23rd July 24. The concept of indexation has been done away with. Whatever is your gain, the difference between the original purchase value and the sale value, you have to pay tax at a rate of 12.5%. So if you bought a property for 1 crore, selling it for 2 crore, the gain is 1 crore. On that 1 crore, you have to pay 12.5% tax plus surcharge plus education cess. So we'll see a separate slide. What are the rate of surcharge and education cess as well. So it's very straightforward. Whatever is your value of consideration, less whatever expenses you do for the purpose of handling the transaction, like maybe if you're paying any brokerage or a commission for an agent who is helping you in the transaction. So provided you have a receipt and it is a bank transfer, you can reduce it from the sale consideration, less cost of acquisition, less cost of improvement. In case you have paid any expenditure for the structural change of the property, so that is also allowed as a deduction from the cost of acquisition. For example, now, so it is very simple. If you bought a property in 2010 for 1 crore and selling it for 3 crore, so whatever is the difference of 2 crore, this is your capital gain. But what happens to a property which was bought before 1/4/2001, or maybe you got a property through inheritance? Your parents bought the property in 1980, 1990, and you got it through inheritance and you are selling it now. In this scenario, what you have to do is you have to see what is the fair market value of the property as on 1/4/2001. That would be considered as the purchase price for the purpose of calculation of capital gain. So original purchase price is no more to be seen when it is calculating a property capital gain for purchase before 1/4/2001. So this is the cutoff date which you have to remember. So primarily all long-term capital gain are subject to tax. Government gives you an incentive by various mechanism. So one mechanism is you reinvest into another residential property or you put into the bond. So there are three sections which govern the exemption part: 54, 54EC and 54F. Let us first understand section 54, which talks about capital gain arising from sale of a residential property. So here we are only talking about the residential property. We are not talking about any commercial land, commercial office, commercial, space, or for example, if you have any mutual fund or shares. So all these are governed in 54F. So this is the difference. If you have a house where you can live in, maybe a villa, apartment, or an independent house, this is governed under section 54. What does it says is you have to reinvest the entire capital gain into a new property to claim for the exemption. And timeline for the new property to be delivered to you, the possession should be delivered to you in 2 years from the date of sale. So if you're selling the property today in April 2025, the new property should be delivered to you by April 2027. Whereas if you're buying a land and constructing a house for yourself on that, the date of completion for the construction is 3 years from the date of sale. That is by April 2028, your completion should be done. So this is +2 and +3 year condition. This is also valid. This is also holds good for any property that you have bought 1 year before from the date of sale. So for example, if you're selling the property on 30th April 2025, and if you have bought any property after 1st May 2024, this property is also good for to claim for the exemption purpose. The new property that you are buying, of course, would be under lock-in. You cannot sell it off from 3 years. So until 3 years, you cannot sell. And further, of course, if you want more time to identify, considering that amount is on higher side, you have too many options available which property you want to buy. What does government says? You have to put the gain amount into a designated bank account called as capital gain saving account opened with the PSU bank. You put the gain amount into this bank, and whenever you are decided which property you want to buy, use this designated bank account to pay off to the seller. So that is how this works. Second is, in case you don't want to reinvest the proceeds of the capital gain into a residential property, government says you can invest into the bond which are specified by the government of India, like REC, NHA or HUDCO. So at present it is REC and HUDCO which is available. And the maximum amount of reinvestment you can do and claim benefit is up to rupees 50 lakh. And it has to be done from the 6 months from the date of sale. And of course, bond is also under lock-in of 5 years. Whatever interest you get, approximately you get is 5.75%, and it is taxable for you. What additionally you can do is you can even mix match and do 54 and 54 EC also. So like for example, if you have a 1 crore 50 lakh gain, you can put 1 crore into a residential property, claim exemption under 54, and you put 50 lakh into the bond and claim an exemption under 54 EC. By this, entire 1 crore 50 lakh would be exempt for you. Now coming to the another section, which is 54F, which talks about capital gain arising from a sale of an asset which is not residential house in nature. So you sell land, commercial office, shop, mutual fund, shares. You can claim for the exemption if you invest entire sale proceed into the residential house. So in 54 and 54 EC, what we were doing is we were investing only the gain amount. In 54F, we have to invest the entire sale proceeds to claim for the exemption. Rest of the conditions are exactly same the 54. One additional restriction in 54F is to claim for exemption, maximum number of property, maximum number of residential house that you should be having, including the new asset that we are buying, should not exceed 2. In short, if you already have 2 houses in India, you cannot claim for exemption in 54F. Okay, coming to the tedious part, which is actually very tedious for NRI, and why I will tell you. Let us first understand what are the rules for a seller who is a resident Indian, and then we come to the NRI part. So if you are a resident Indian selling a property in India for a value which is over and above 50 lakh, buyer is required to deduct TDS at a rate of 1%, pay to the government via a form called as 26QB, which is a PAN-based form. So tomorrow, if you happen to buy a property from any resident developer, for say example 1 crore, 99 lakh you would pay to him, and 1% of 1 crore, which is 1 lakh rupee, you will pay to the government on developer behalf, and he would be claiming the same when he files the income tax return. And the onus of this compliance is on you. If you fail to do so, there would be a penalty and interest would be charged on you and not the seller. Okay. Now let us understand how the difference happens when the seller happens to be a non-resident Indian. In this scenario, irrespective of the value of the property, when as a non-resident Indian, you are selling a property which is long-term in the nature, TDS is to be deducted at a rate on which you have to pay tax. So earlier the tax rate was 20%, so was the TDS rate also 20%. Now the tax rate has been reduced to 12.5%, so TDS rate is also 12.5%. Of course, it is to be added with surcharge and education cess. And to pay this TDS, buyer needs to apply for a TAN number and file for a 27Q, which is a quarterly form that needs to be done for you to claim this TDS. So buyer is required to deduct TDS and issue you form 16A so that you can claim the TDS. Now here what is important to note is TDS is being deducted, or in other words, it is also called as withholding tax. Withholding tax is being done on the sale value, and capital gain tax you pay is on the capital gain, the profit part. So it will always be that tax is being withholded at a higher value. So government will have a value hold it, and what option you have is either you file your income tax return and claim it as a refund, or another alternative is once you have identified the buyer, apply for a lower TDS certificate and tell the income tax office, see, this is my capital gain and I want a lower TDS certificate. On being satisfied, income tax office issues you a lower TDS certificate, which will be equal to your tax liability. There would be no question of excess being withholded by the government. And this is a good feature, a good opportunity the NRI should be availing, so that their capital is not blocked with the government for a period on an average which goes from 12 months to even 18 months for that matter. So this is an illustration. If you have to see what is the option number one is claim refund. So if your sale is 1 crore, your cost of acquisition is 90 lakh, gain is 10 lakh rupees. Tax that you pay on this transaction is 1,49,000. But what would be the withholding tax? It would be 14.95% of 1 crore, which is 14,95,000. So what happens is you claim a refund for 13,46,000 only when you file your income tax return. Whereas if you apply for a lower TDS certificate, you get a rate for 1.49%, which is your tax liability divided by the sale value. You don't pay any tax or withholding tax in addition to your tax liability. So this is the benefit you get. Okay. Coming to the rental part, whatever income you get from renting the property, you have to pay tax as per your slab rate. India has a progressive slab rates. Plus, since this is also an income paid to an NRI, Section 195 requires the rental income paid to you should also be deducted with the tax, and which is also the withholding tax, which is 30% plus education cess of 4%, making it effective rate of 31.2%. So the tenant it is mandatory for him, irrespective of the income, irrespective of the rent he is paying, TDS should be deducted at a rate of 31.2%. Further, what advantage you have, what benefit, what deductions you get if you are giving a property on rent is deduction for the municipal taxes paid, and second is the 30% standard deduction you get for the repair and maintenance, irrespective of the fact that you are spending it or not. So you do it less, more, doesn't matter. Whatever is the rental receipt you get, 30% is standard deduction you get, balance 70% is only chargeable to tax, and that too as per your slab rates. Further, if you have taken any housing loan on that, you get the deduction for the interest and as well as for the principal under Section 80C. Here, there is a very important concept, which is the deemed rental income. This is the only provision in the entire Income Tax Act which charges tax on an income which has never been paid to you or will never be paid to you. The concept is, the government says the maximum number of house property you can hold for yourself is 2, and in case you are holding more than 2 self-occupied property, means the third property which you have more than 2 and you claim that it is not on rent, which is self-occupied, would be covered under the deemed rental income clause. You have to ascertain the fair market value of the rent that you can get over the property, take 30% deduction, take municipal taxes deduction, balance becomes part of your total taxable income. So this is even if you have not let out the property, deemed provisions come into play. So these are the slab rates, financial year 24-25, the center column you see, till 3 lakh you don't pay any taxes. So this is for the ITR, that is due now. So financial year 24-25 just ended, 31st July is the due date. If you're filing for the income tax return under new regime, these are the slab rates which are applicable. So if your income is over and above 15 lakh, you pay 30% tax. Now, what change in the budget 25, which is applicable for current financial year, that is 25-26, is till 4 lakh, you don't have to pay any taxes, and every additional 4 lakh, there is additional tax of 5% that is to be paid. So now, if your income is over and above 24 lakh, that is when 30% bracket comes into picture. So if you, for example, if you are income over and above 24 lakh, if we see the difference only in the regime of 24-25 and 25-26, that is under new regime, you would be saving a tax of approximately 1,10,000, considering the benefit that has been passed to you. Whereas this is for the non-resident, The 12 lakh limit, you would have heard a lot of WhatsApp messages, till 12 lakh you don't have to pay any taxes. This is only for resident individuals. The rebate that government is providing is restricted only to the resident. For NRI, there is no such rebate available. For you, the basic exemption limit continues to be at 4 lakh for financial year 25-26. Plus surcharges to be added depending on the range of income. And of course, education cess is also applicable 4% on your total tax liability, which is tax plus surcharge amount. Adjustment of losses. This is a very important topic. What you need to understand here is, in case you have a loss from a particular head of income, you can set it off with the respective head of income. Wherever I have written yes, if you see, for example, if you see long-term capital loss, if you have, you can set off and carry forward the loss against the income head if it is long-term capital gain nature. So today, if you have any loss from, say, shares, and you have a long-term capital gain from mutual fund and shares, you can set it off. Whatever is the balance, you have to pay tax. In case there is an unabsorbed loss, provided you file your ITR before the due date, you can carry it forward up to 8 years. So this is very important. You should be filing your ITR before the primary due date of 31st July in case you want to carry forward of the losses. So financial year 24-25 just ended, 31st July is the due date. This is rather the best time now. The documentation, the checklist you should be starting with. In case you want a checklist of the documents, what is required, you can send me a WhatsApp. I will be sending you. This is a ready referencer checklist which I have made. Whatever is applicable, you should start collecting these documents now. And by end of the May, when your TDS data is updated online, AIS, TIS data is updated online on the tax portal, you should be reconciling with the same and then proceeding with the tax filing. So June first week is the best time to start filing for the tax return. And of course, 31st July is the due date. In case you miss upon this due date, you can of course file for a belated income tax return. That is by 31st December, subject to a penalty ranging from 1,000 to 5,000. And disadvantage being that you cannot revise your income tax return if you have filed as a belated ITR. And second disadvantage is, of course, you can set it off, but you cannot carry forward the unabsorbed loss. So to revise the income tax return, have the benefit, and also to carry forward and set off the loss, you should be filing your ITR by the due date of 31st July. So primarily, income tax allows you to file income tax return only for 1 year at a time. However, for any reason you missed filing the income tax return in India for the previous year, government says you can file your ITR for 4 years now, provided there is income and taxes payable on that. It means you can file for an updated return for 4 years, provided there is a tax liability. It should not be a return of loss. It should not be reducing your tax liability, and it should not result in refund. So for sure, you cannot claim for a refund for the past year. You can file for an updated return with additional tax and interest, which ranges from 25% if you're filing for 2 year, and it goes up to 70% if you're filing for 4 year. The advantage of this is, tomorrow if income tax department comes to know, they would be levying a additional tax and interest which goes even up to 200%. So penalty of 200% would be saved if you voluntarily pay off the same using updated return, which ranges from 25 to 70%. So this is an amendment now. So earlier it was only restricted till 2 years. With budget 25, government now made it available to 4 years. Okay. So this was about the mandatory part. So now, if you don't have taxable Indian income, should you still be filing income tax return in India? I always strongly recommend that you should be filing ITR in India, for the very reason that government doesn't charges you anything for filing ITR. So at no cost, you get one document, first of all, which substantiates your residential status and sources of the income to the government of India. This brings in more transparency, more records are clean for better financial records for the purpose. So it is always advisable you have your Indian income tax return filed. Second advantage is TDS is always deducted on a higher rate for NRI. You file the ITR, government will process whatever excess TDS has been collected as a refund to you. It will also help in being eligible for a loan. Tomorrow, if you become resident in India, you apply for a loan. First document any banker asks is income tax return for 2 years. So you can file 1 year at a time, but for the second year, you will have to wait. So if you have been continuing filing the income tax return, your eligibility is very good. And loss, I have already told you to carry forward the loss. it is mandatory for you to file ITR before the due date. At times, people ask me, Ajay, should we disclose foreign income and foreign asset while we are filing ITR in India as a non-resident Indian? The answer is, it is not mandatory for you to file for the foreign asset and foreign income in the income tax return. However, the day you become resident of India and you continue to have foreign income and foreign asset, it will be mandatory for you to file for foreign asset schedule and foreign income schedule when you become resident of India. A non-disclosure of foreign income and foreign asset leads to a heavy penalty under the Black Money Act, and the penalty goes up to even rupees 10 lakh for that matter. Okay. As an NRI, you have primarily two bank account, NRO and NRE, and third is a deposit account, which is an FCNR, which is a multi-currency deposit you can have. It is mandatory for you as an NRI to convert all your saving account into NRO. You cannot continue having a saving account. And in addition to NRO, you have an opportunity available where you can open an NRE under the same customer ID. NRE is your non-resident external account. This is as good as a foreign bank account, with the only difference that it is opened in India and it is in INR. If you have to deposit any money in NRE account, it can come only through your foreign sources. So primarily as a individual, you cannot have money being deposited in your NRE account through an income which is Indian in nature. Okay. So primarily money cannot directly go into NRE. However, for that reason, if you want to transfer funds from NRO to NRE or from your NRO to your foreign bank account, as a non-resident Indian, you can transfer up to 1 million USD per annum per person, subject to compliance. Number one is tax should be paid on that. There is an online form, income tax form called as Form 15 CA, which needs to be filed. And second is CA certificate in Form 15 CB, where we certify that this money is free to be remitted. Based on this, you go to the bank, you send them 15 CA CB, you can remit up to 1 million USD per annum per person. In case even you are selling a property in India, or for that matter, you are selling inherited property in India, that money also you can remit outside India. You are free to use that money. So there are a few more important points, and then we can conclude the session with the opening of the Q&A part. So in case you have an Aadhaar card, it is mandatory that you link with the same with your PAN card. And also in case you don't have an Aadhaar card, ensure your PAN has been operative. In case you log in and see your PAN has been inoperative, you have to migrate the same to the International Tax Office, which will effectively make your PAN card operative. Next is dividend income. For a non-resident Indian, having a dividend income, it is taxable at a flat rate of 20%. Whereas if an individual is a resident, it is taxable as per the slab rate. So this is a common pitfall. You have to be very cautious about same. Dividend income for NRI is taxable at 20%. Third, if you receive a gift for over and above rupees 50,000 from non-relative, this becomes part of your total taxable income. Please ensure whatever transactions you are doing from non-relative, they are structured and taxation is taken care for the gift part as well. PPF and Sukanya Samriddhi account. If you have opened these account as a resident and then you became NRI, you can continue to hold till its maturity. As a non-resident Indian, you cannot open a new PPF or a Sukanya Samriddhi account, or you cannot request for an extension also. Last point, for the agricultural land, agricultural land can only be bought by a resident and a farmer. As a non-resident Indian, no way you can buy an agricultural land. Only exception available for you to have an agricultural land is through inheritance. So that is from my part. It is very important. I see a lot of people coming and selling you farmhouses, weekend villas and all. In case you are buying such farmhouses, you have to ensure that these farmhouses are built on a NL land and not on agricultural land, because indirectly you are investing into an agricultural land, which is a prohibition from the FEMA. All right, so these are the things which I wanted you to be very sure. These are the common pitfalls, and I wanted to highlight. We are open to take up the questions now. I think we can go to the chat box. We'll take up, and in case you have anything, you can WhatsApp me. This is my personal WhatsApp number, and happy to take your questions. So there is a question in the chat box. I will read and respond.
Yeah, and Ajay, maybe you can stop sharing. We can put your number in the chat box so everybody can copy it.
Yes, I will do that. All right. Yes, ma'am.
Yeah. Very good.
I will go
So,
to the chat box.
yeah, thank you.
We have a
So,
commercial property in India and I have taken a loan to build that commercial property other than tax benefit. So whatever interest you pay, you can get a set off against the rental income on that. You can take the advantage of that. Can PAN and Aadhaar linking be done on? Yes, this is an online activity only. You can visit incometax.gov.in. That is the portal. On the left hand side, you will see an option link PAN and Aadhaar. You will have to pay a 1,000 rupee challan, late fee penalty, and based on that, you can link PAN and Aadhaar card.
we have somebody raising a hand.
Yeah, so you can unmute and
Yes, please unmute. Please enable
Yeah.
your video and you can ask the
Thank you.
question.
Yeah, thank you, Ajay. Yeah, I think wonderful presentation. I am also a chartered accountant. So, because I am working in aerospace industry, typically, generally, we keep getting two general questions for NRI, different context. So, if you are following recently, the Mumbai ITR has given an opinion on NRI that sale of mutual funds is taxable only in the country of residence. So the case was going on, and she has won that case. Basically, it was a short-term capital gain. She earned about I believe 1.3 crores on the redeeming the mutual funds, and initially it was taxed, and tax was paid, but she went to income tax appellate tribunal, and then it was Mumbai ITAT ruled that, oh, it's not taxable. The reason being, it should be taxable only in the country of residence. And since he was staying in Singapore, uh, so ITAT ruled that it is not taxable in India. So have you heard this case or any such references you have? So
yeah.
the route, one route, of course, yes, pay tax and then claim refund. So it may be a bit longer process, but instead of that, claiming that, okay, NRIs, of course, they are not resident currently in India,
I
using
understand
NRI
your
as a
question.
base,
I,
can they
I was
claim?
waiting for this question to come up. I was pretty sure this would be coming up. And the thing is, yes, this has been for long, and this is not a new thing. Only thing recently it has been highlighted for the reason it has a recent tribunal judgment coming in. So it says you can benefit from the double tax avoidance agreement, and this was primarily for countries like UAE and Singapore, wherein it says that capital gain arising from a mutual fund would be exempt from them. So for Indonesia and India double tax avoidance agreement, there is no such benefit available. So if you are NRI based out of Indonesia, you will have to pay tax on the capital gain in India. So this benefit is not applicable to you.
Yeah, so it's only the specific countries where
Only these
there is a
specific
tax treaty.
countries mentioned. Yeah.
Yeah, yeah. So
But
and
at the
just
same time, I will add here, you can
Mhm.
benefit on the interest and the dividend part. So you will have eventually to be paid tax on a lesser rate if you have been a non-resident Indian based out of Jakarta, and the condition is you should be having a TRC available from the local country, and before filing the income tax return, you need to file for a Form 10F. So
Yeah,
based on that, you can reduce your tax liability on the interest that you get maybe from your NRO deposits or the dividend income. So unlike 20%, you will pay tax at a reduced rate.
that's correct. Okay. So this another question. Important is that NRI, of course, wants to invest in the agriculture land. So one of the other clause under FEMA is, have you ever experienced that going to FEMA, getting the exception approval for
The
NRI
RBI never does that.
to
It is
buy?
written that, but RBI will never give you an approval.
Okay, so it's basically just the law, but
Yeah.
there are no cases that they have
No
given
precedents
approval
available
for.
where RBI has given permission for an NRI to invest in agricultural land. There is no such precedents available.
Oh, there is no precedent so far. Okay.
Yeah.
Okay. Thank you.
Thank you.
So we have other questions also,
So
Ajay.
in
We
case of
have,
a recurring deposit where maturity is not in the current, do we pay taxes in Indonesia? So see, I would not comment on the Indonesia taxation because I am not an expert in that. I would restrict myself to the India part. But coming to this question on the India part, so fixed deposit, if you do primarily, it is of two types. Either you get interest paid on the regular basis or it is a cumulative deposit. So if considering this is a cumulative deposit and you have made an NRO, whatever interest you get on accrued basis, every year you have to make it part of your total taxable income and pay taxes. And it is not that way that maybe you have done a fixed deposit for 5 years, you get the interest amount at the end of 5 years. That year you have to pay taxes. It is not that way. Whatever income that has been accrued you for that particular financial year, that becomes part of your total taxable income in that particular year only. I am holding deposit NRI account. Can I convert the deposit in USD currency under FCNR and keep the same bank? Yes, what you can do is, if you have funds available in NRI, you can transfer it to FCNR and you can have a foreign currency deposit being maintained. So you can open an FCNR account and make a fixed deposit. Primarily, it is available in 4 currencies. It can be in USD, it can be in Euro, Pound, and the fourth currency I think is Yen. So these 4 currency option you get while maintaining FCNR. I have a PF account which was opened through a previous employer. Yes, you can continue to hold, or if you want, you can mature it. It has no relation with the change of your residential status. So within the stimulated period, you can close that account.
So I think these are the questions so far. If anybody else has any more questions, please put them in the chat box, or you can raise a hand and speak it aloud.
Yeah, Ajay, one more last question. My friend is pushing me to ask again. So, unfortunately, some of them, they have bought an agriculture land, being an NRI. So, of course, they are worried about the implications. Maybe could you highlight quick what would be the ramifications or implications on having currently they have already bought. So,
So this is a very normal thing, and to be very honest, I haven't come across RBI or FEMA coming down heavily as of now. But you never know tomorrow when the RBI gets activated. So compounding is an option available, but it's not very sure RBI would compound the offense or not. So maybe you can preferably exit from that investment or transfer it to someone who is a resident Indian. Immediately, I can see that as a rescue.
yeah, thank
Manoj is raising the hand.
Mr. Ajay. Actually, I want to ask, but you say that Indonesia tax you are not so expert. I have only because I am an NRI last 20 years and now working in Indonesia. And I have my deposits in India, fixed deposits in NRI account. As per Indian government rules, there is a nil or you can say zero tax on the NRI interest. So do we need to pay this interest earning in Indonesia as a tax?
So that's what I responded. In India, it is exempt for you. For Indonesia taxation, you need to consult a local chartered accountant there who would be helping you on the taxation. So I am not an expert in the Indonesian taxation. So I would reserve my comment on the taxation in Indonesia front. That is the reason I said.
Okay. Thank you.
Thank you, sir.
I think, Ajay, that was a very interesting and very informative presentation. And I thank you for sharing your expertise with all of us. And, I saw a message saying that please can you share your presentation. If you can share your presentation, we'll put it on our webpage so everybody can have a look at it along with this live cast, the YouTube video.
Thank you so much for having me here. I enjoyed a lot. This has been my passionate subject. So given the opportunity, I always see that I can do my best.
Thank you so much. In fact, going forward, if there is more interest, we can also do a specific session on Q&A, just Q&A, and we can take it from there.
Absolutely. Would be happy to do that.
Okay, Ajay, thank you.